This is section 2 of the POA 2017 past paper. In this section, we have to answer 2 questions. First question reads, ships 180,000, loading equipment 93,000, accounts receivable 42,000, cash 18,000, accounts payable 61,000, 6-month investment in government loan scheme 12,000, 5% 3-year loan from Warren Bank 90,000, bank overdraft 8,000, prepaid insurance 15,000. Additional information: house has contributed twice as much capital as home. They say using the vertical style, draw up a classified statement of financial position, a balance sheet for house and home partners as at the 31st of December 2016. Okay, so let's get started on this balance sheet. Be sure you have your title, house and homes, partners, balance sheet as of the 31st of December 2016. Assets for this question: fixed assets are ships and the loading equipment. That's it. The cost is 180,000. They did not give us any information for depreciation. So we have no information, nothing to depreciate here. So the net book value will remain the same, our current assets. So let's identify the current assets from the list provided. It's going to be accounts receivable, cash, 6-month investment in government loan scheme, and the prepaid insurance. First one we'll write is accounts receivable. The second one will be the 6-month investment in government loan scheme. The third one will be prepaid insurance, and the fourth one will be cash. So this is the order in which we are going to write it under our current assets. So the accounts receivable is 42,000. 6-month investment on government loan scheme is 12,000. The prepaid insurance is 15,000, and the cash is 18,000. When we add our current assets, we're going to get a total of 87,000. Now on to our current liabilities. So we have accounts payable, bank overdraft. So we have 2 items to put in our current liabilities. Accounts payable is 61,000, and bank overdraft is 8,000. This is going to give me a total of 69,000. It's going to be your total current liabilities. After subtracting it, we're going to get 18,000. After completing my fixed assets, I just realized that I didn't add the total, so I will do that now. 180,000 plus 93,000 will give me 270,000. Now I'm going to add 270,000 and 18,000, and this is going to give me a total of 291,000. This is going to be my working capital. I'm only seeing one long-term liability item in this question. Everything else was used besides the long-term liability item, which is the 5% 3-year loan from Warren Bank. So we're going to write that, which is 90,000. Subtracting it from our working capital figure, we are going to get a total of 201,000. Last part of our balance sheet, financed by. They told us what the capital was for house and what the capital was for home. So we're going to work that out. The capital for house. It told us house has contributed twice as much capital as home. So the working capital figure we have here, which is 291,000, house has contributed twice as much as home. So therefore, house will have contributed 2/3 of the capital, while home will have contributed 1/3 of the capital. So for house, we'll have to calculate 2/3 of 291,000, which will give us 134,000. And then home contributed 1/3 of 291,000. And this is going to give us 67,000. And after adding 134 and 67,000, we are going to get 201,000. After adding 134,000 and 67,000, we are getting 201,000, and that's our balance sheet for this question. The other part of this question, part B of this question, that house and home have decided on the following arrangements in sharing profit and losses. Okay, interest and drawings should be charged at 8% per annum. Each partner is to receive 10,000 each year as an investment income. Home is to receive an annual salary of 18,000. Remaining profits or losses will be shared in the ratio of their capital contribution. We worked that out before. The following additional information is also available after appropriation. Profits totaled 24,000 during the year ended 31st of December 2016. Current account balances as of the 1st of January 2016 were house 34,000 and home 60,000. Drawings taken for the year were as follows: house 20,000, home 10,000. This question wants us to use the forms provided on pages 19 and 20. I'll show you them, and prepare the partners' current accounts to show the changes in their balances over the year. So the forms was provided for you to complete the current account of both partners. So we're going to complete the current account for home as well as house. Of the important information that we need to put in here, they told us the interest charged on drawings should be 8%. Also, what is the brought down figure? They told us that here. So we're going to start with this. Okay, so the balance carried down for house is 34,000. The balance carried down for home is 60,000. Drawings taken for the year was as follows: house 20,000 and home 10,000. So let's enter that. House was 20,000 and home was 10,000. After that, they told us the interest on drawings is going to be 8%. So we have to find 8% of 20,000. Let's write interest on drawings. 8% of 20,000 is going to give me 1,600. It's going to give me 1,600. The interest on drawings for home, we have to find 8% of 10,000, and that's going to be 800. The other information, let's cross out, highlight all the information that I'm using so you all can see it. They give us the drawings and the interest on drawings. Okay. If they told us the remaining profits and losses, the remaining profits or losses will be shared in the ratio of their capital contribution. So their share of profit for house, there was going to be, if we go back to the question before, remember we worked that out. The question told us that house has contributed twice as much capital as home. Okay, so house was 2/3 and home was 1/3. So that's the share. The share of profit will be calculated like that. House will get 2/3 of 24,000 and home will get 1/3 of 24,000. So the share of profit for house will be 16,000 and the share of profit for home will be, again, let me just highlight the information. It told us the remaining profit or losses will be shared in the ratio of their capital contribution. Okay. They told us that each partner is to receive 10,000. Let's add this in for both persons. This is their investment income, 10,000. Both partners are receiving the same. They also told us that a home is to receive an annual salary of 18,000. So we have to add that. Home's salary of 18,000. And I think we covered everything. This was the profits that we used when we were calculating their share. So all the information here is in. Let's balance off both home and house current accounts. 34,000 plus 16,000 plus 10,000 will give me a total of 60,000. The balance carried down figure, we will get that by subtracting 21,600 from 60,000, and we will get 1,400. On January 1st, 2017, we're going to have our balance brought down figure of 38,400. Let's balance off home's account as well. 60,000 plus 8,000 plus 10,000 plus 18,000 will give me a total of 96,000. I'll get my balance carried down figure by subtracting 10,800 from 96,000. And I'm going to get a total of 85,200. The 1st of January 2017, the balance brought down figure would be 85,200. And that's it for this question. We have the current account for house and the current account for home. Thank you all for joining me. Be sure to like, share, and subscribe to my channel for more.